In today's rapidly evolving financial landscape, digital banks and fintech apps are challenging the dominance of traditional banks with faster services, lower fees, and mobile-first convenience. But with deep-rooted trust, regulatory oversight, and full-service offerings, are brick-and-mortar banks still relevant? How banking has transformed in the digital age, and whether traditional institutions still hold value in a world driven by innovation and instant access. Today we will talk about banking in the digital age. Are traditional banks still worth it? So before we start, make sure to hit the like button and subscribe to my channel. 1. The evolution of banking. From brick and mortar to bytes and code. The financial industry has undergone a radical transformation over the past 2 decades. Traditional banks, long associated with towering buildings, marble floors, and in-person transactions, now coexist with sleek digital platforms, offering banking services at the touch of a button. This shift was accelerated by the widespread adoption of smartphones, broadband internet, and fintech innovation. The digital age has brought with it mobile-first banks, decentralized finance, DeFi, and artificial intelligence-powered customer service. Yet, amidst these changes, many legacy banks have adapted by offering digital interfaces and online services to remain competitive. However, the question remains, with such a fast-moving digital landscape, do traditional banks still offer enough value to justify their place? Historically, traditional banks have served as the backbone of financial infrastructure. They offered not only personal and business banking services, but also played roles in national monetary policy, credit systems, and global financial stability. With large capital reserves, regulatory oversight, and established customer trust, they held a near monopoly on essential financial services. But the digital transformation has challenged that dominance. Fintech startups and neobanks, like Chime, Monzo, or Revolut, have entered the scene offering quicker services, lower fees, better interest rates, and smoother interfaces. This has prompted consumers, especially younger ones, to question the necessity of maintaining an account with a traditional bank. 2. Digital-only banks. What makes them so attractive? Digital-only or neobanks have reimagined what banking should look like in the modern era. These institutions typically have no physical branches, allowing them to operate with significantly lower overhead costs. These savings often get passed on to customers through higher interest rates on savings accounts, reduced or no-fee structures, and cashback rewards. Mobile-first experiences, seamless user interfaces, and real-time transaction notifications are standard. Many also integrate budgeting tools, expense tracking, and automatic savings features, all designed to appeal to the tech-savvy generation. Security, a major concern in digital finance, is often well addressed by neobanks through biometric authentication, two-factor verification, and AI-driven fraud detection. In addition, APIs, application programming interfaces, allow for integration with third-party apps for investing, crypto trading, and personal finance management. This ecosystem-style banking is much more agile and user-centered than the monolithic systems of traditional banks. Moreover, digital banks are known for faster onboarding, often allowing customers to set up accounts in minutes without stepping foot into a branch. All of these innovations pose a serious challenge to traditional banks, which are often slower to implement changes due to bureaucratic inertia and legacy systems. 3. Where traditional banks still excel. Despite the digital revolution, traditional banks still hold several critical advantages. First and foremost is their long-standing credibility. Being well-regulated and often insured, for example, through FDIC in the US, they provide a sense of financial security that digital banks may lack, especially those not backed by government deposit insurance. For many consumers, especially older generations or those in rural areas with limited internet access, the presence of a physical branch provides comfort and a sense of legitimacy. Traditional banks also excel in areas where digital banks struggle, like complex financial services. These include mortgage lending, small business loans, wealth management, and investment banking. The human touch, including in-person financial advisors and relationship managers, is often preferred when making large, life-changing financial decisions. Moreover, many traditional banks have adapted by developing hybrid models that combine in-branch and digital services. Some have invested heavily in digital transformation initiatives, using AI and blockchain to streamline operations and compete with fintech disruptors. 4. The role of regulation and consumer protection. One of the fundamental pillars supporting traditional banks is robust regulation. National and international frameworks such as Basel III, Dodd-Frank, and GDPR in Europe ensure that customer data and money are handled with the utmost care. Traditional banks are closely monitored for capital adequacy, liquidity, and risk management, providing a safety net in the event of financial crisis. In contrast, the regulatory oversight for digital-only banks and fintech firms varies significantly depending on jurisdiction. Some operate in gray areas where laws have not yet caught up with innovation. For instance, while most neobanks are regulated in the countries they operate in, some partner with traditional banks for deposit insurance or use third-party financial service providers. This creates a layered ecosystem where accountability can sometimes be difficult to trace. Moreover, the rise of decentralized finance, especially through blockchain-based platforms, raises complex questions about consumer protection, fraud liability, and recourse in the event of digital theft. These concerns highlight the enduring value of a highly regulated, accountable banking system, which traditional banks still represent. 5. Customer service. Digital convenience versus human interaction. In the age of chatbots and self-service portals, customer service has taken on a new dimension. Neobanks pride themselves on 24/7 support via in-app messaging or AI chat assistance. While convenient for basic queries, many customers still value the ability to speak with a real person, especially during disputes or emergencies. Traditional banks, with established call centers and branch staff, offer this kind of interaction, which can be crucial when navigating fraud investigations, loan disputes, or financial hardship. However, the customer service landscape is evolving. Some traditional banks are falling behind due to long wait times, outdated systems, and bureaucratic hurdles. At the same time, digital banks are experimenting with hybrid support, combining automation with access to live human agents when needed. Ultimately, the best customer experience is likely to come from institutions that offer both digital convenience and empathetic, efficient human interaction. This balance is something that traditional banks are still struggling to perfect, while neobanks are quickly iterating toward it. 6. Financial inclusion and accessibility. One of the greatest promises of digital banking is financial inclusion. With just a smartphone and internet access, people in underserved or remote areas can gain entry into the formal financial system. This has massive implications for emerging markets, where traditional banks may not have the resources or incentives to build branches. Mobile banking can empower the unbanked by offering tools for savings, credit building, and digital payments. Governments and NGOs are increasingly partnering with fintech firms to distribute aid, offer microloans, and build digital identities through mobile banking systems. However, digital access is not universal. In many regions, internet penetration remains low, and digital literacy is limited. Traditional banks, through community outreach, in-person education, and long-standing customer relationships, often play a role in bridging this gap. Moreover, accessibility for the elderly and disabled is an ongoing challenge in the digital sphere. For example, some mobile banking apps are not optimized for users with vision impairments or cognitive difficulties. 7. The hybrid future. Collaboration, not competition. Rather than a zero-sum game, the future of banking may lie in synergy. Increasingly, traditional banks are collaborating with fintech firms and integrating digital tools into their operations. These partnerships allow legacy banks to innovate more rapidly while offering the trust and compliance infrastructure that startups lack. For example, Morgan Chase has invested heavily in blockchain and AI tools while also acquiring fintech startups. Similarly, Goldman Sachs launched its consumer banking arm, Marcus, as a digital-first initiative. If you like this video and would like to see more like it, please give it the thumbs up. Leave a comment and click the button to subscribe.